Kevin, it's an honor to have you on here, the Green Room. You're working on a on a platform that really fascinates me that I guess finally exists now, and it's going to be able to pump more cash into the solar space, which I think everyone listening already knows is a huge problem. And you guys seem to have a very interesting solution. So first off, thank you for coming on. And why don't you go ahead and introduce yourself to the audience, as well as tell us a little bit about what Finite is building.
Yeah, absolutely. And thanks for having me. Kevin Conroy, the founder of Finite, and what we launched recently is a public fund for solar assets and investors of effectively any dollar amount to invest in solar. So our minimum investment is $500, and it looks and feels very similar to a mutual fund that you buy probably regular course in your life. But what we were finding was, everyone from your $500,000 investor up to your family office that wanted to put, millions of dollars to work in the space really didn't have an avenue to do it. And so that's what we went out to create.
So it's almost like what you guys have identified is a way to give smaller check size investors like me or an angel investor to now participate in, I guess, help finance solar projects and renewable energy projects. Is that an accurate understanding?
Yeah, so it's solar specific in this fund, but the way we think about it is solar is at a unique point of maturity where it's mature enough to be kind of an investable asset class,
Hmm.
meaning it's large enough, it's kind of, you have a history of cash flows that you can point to and look at. It's not so large that huge players are participating in it yet. So it's in this kind of growth phase. It's a really nice area for a company like Finite to bring a product like this live. But when we look down the road, we see a lot of sustainability in a similar trajectory as solar. So um, you can kind of speculate on different asset classes, but whether it's forest projects, regenerative agriculture, indoor agriculture, there's kind of vehicle electrification, energy efficiency, the whole gambit of your sustainable asset classes that we think are either at or entering a phase that we can build a fund around.
Okay, so now what you're effectively, I guess then to fully understand this or appreciate this is solar has now matured over the last decade to be a, I guess, safe.
Uh, yeah, I was going to say I can't say it's totally safe. I am we can't promise returns, right? So,
Sure.
but it's mature, right? I mean, I think when I entered solar 7 years ago, it was really early. You
Oh
had
yeah.
leases and PPAs were the predominant way to go solar on your home. We had just come out of the recession, and there was very little operating performance of how individuals, businesses would pay back a solar loan. Just
Right.
nobody knew, right? And so we've gone from, I think, that phase to most of the originators today have bank partnerships. They're working with mid to large regional or kind of nationwide banks, and you have institutional asset or institutional investors accessing the space. So what we've done is take that asset and really put it into a fund that is incredibly easy to access, or should be at least. It takes about a minute, maybe a minute and a half to go through our investor process. And over time, you'll be able to invest out of your retirement account. You'll be able to invest on the Fidelity or Schwab platform, just like you buy and sell a stock.
Okay. So do I hear like it becoming an ETF someday in the future from the sounds of
That
it?
we're gonna get into the weeds here pretty quick, but it is when you think about um, SEC registered 40 Act funds, right? You have mutual funds, which I think traditionally were very popular and have fallen out of favor slowly but surely over the last 10 years. ETFs have taken up a lot of that slack. And then there's what's called an interval fund, which is what we are.
Hmm.
If you look across those three funds, ETFs are traded. So you can buy in and out every second of the day if the market's open.
Mm-hmm.
Right. And so mutual funds you buy once a day, and you can sell once a day. In both of those structures, you're often not actually buying from the fund, you're just buying from another investor. So it's kind of a traded product. For us, in the interval fund structure, if you buy a share, you're actually buying it from the fund. And so we're making a new share, selling it to you. And what that creates is a level of additionality. So when you're
Okay.
putting money to work, it's actually going into the fund. Whereas an ETF and a mutual fund, it's just kind of traded between investors. And then we, instead of allowing you to sell every day, which would prevent us from owning anything illiquid, we offer to repurchase the shares quarterly. And so we repurchase shares between 5 and 25% of the
Okay.
fund on a quarterly basis. And so what that lets you do is really, um, probably not surprising to people, solar loans are not a very liquid security. It's a fairly illiquid market, but that fund structure allows you to manage it appropriately and avoid some bad investor experiences.
Okay. So then, if for all the people who learned about the stock market due to GameStop last year, um, is this akin to the buying and selling behavior that happens with options when you're talking about ETFs and mutual funds versus an interval fund, which in your guys' case, it allows you guys to buy and sell actual shares in the fund as opposed to secondaries or options and things
Yeah.
of that nature. Is that a correct understanding?
Yeah, I think so. I mean, it of course depends on your reference with GameStop
Sure.
and how involved people were in that. Um, but yeah, we felt that in order to give, we kind of self-regulated and we chose this route of having SEC regulation, FINRA oversight. Um, if we're bringing $500 investors into the sustainable world, it needs to be in a way that is highly regulated. That's kind of the appropriate way to do it. Um, we didn't want it to be something that, you could claim accreditation as an accredited investor, even though you really weren't. This explicitly a non-accredited investor can invest in, or unaccredited investor, which is really exciting because it takes what is something I would consider a very exclusive asset class and
Right.
makes it open to everyone. When I say very exclusive, it's exclusive when $1 billion family office doesn't have good access to it. So it's kind of from that level all the way to $500.
Okay, so then I think that's a perfect segue into trying to understand more of this platform. If you could, for the entire audience, could you break down here's the problem that we've identified? You've already mentioned that lack of access is a huge, huge component of what inspired the creation of Finite. But as it stands today, what is the biggest challenge you found? And what is the platform that you guys have built today? And naturally, you've gone through the SEC, and there were probably multiple hills and valleys that you guys had to kind of power through to get to this stage where it's launched and people can put money into. But I'd love to dig into that side because it seems there's some interesting storylines that we can kind of learn from here.
Yeah, and we can pick that one apart maybe one by one. I mean, I think
Absolutely.
that what I kind of tell people is a lot of people think the SEC is the going to be the problem in our process. And to be candid, they were
Yeah.
very supportive. They were one of the easier parties. Yeah, and that's
Okay.
I would say I think flies in the face of a lot of maybe preconceived notions on their process, but we spent a lot of time with our attorneys drafting the documents in a way that I think covered a lot of things they historically have had problems with in these funds. But it goes so far beyond the SEC because we also have to have a bank custodian for these assets and a transfer agent, a valuation agent. You have to get audited, right? And so one of the things that I think has been true for a while, but is particularly true right now when everyone's pretty busy, firms don't necessarily want to work with new fund managers. Like our bank custodian is US Bank, and they service huge customers, and even if we're moderately successful, we're still going to be one of their smaller clients. I mean, it takes decades to be one of their huge clients, and so just getting in the room for some service providers was tough. But then, of course, getting the documents to a point of SEC submission was important, and then we have the fund has its own board of trustees, which is kind of a governance function. But
Hmm.
that board document, board book, as people would kind of refer to it, for us was a 1,200-page book, which you just don't think of many early stage companies having to deal with that, right? Their board books are like maybe 10 slides going through financials and key initiatives. So I think that for us was a pretty big maturing element where we want to have the nimbleness of a startup, but recognize we are not, right? People are trusting us with their investor dollars, and we can't fail fast. It's kind of an element of our business that is not similar to other startups, and forced us to act, I think, highly mature in a highly regulated environment.
So it's almost. I mean, I imagine this is the case for a lot of fintech kind of companies, but it feels a lot like the access to credit cards or charge cards that Brex did, which I imagine wasn't easy either, trying to find a bank partner to then work with in order to just get their credit card created and such. You didn't have the Marquettas of the world, which you can just go
Right.
to and get your credit card created, or banking as a service platforms that you could just API into these days, because
Yeah.
you're working with an industry that historically is very paper pencil or Excel sheet, and Windows Vista. Uh, but it's it's almost like you guys needed to know or have the foresight, or you have that foresight to determine that putting this fund together and bringing that ability of access and opening up a brand new pool of capital to help fund a electrification effort was the big thing that's allowed you guys to get to this stage. So what was it like in those early days just before? Because I'm sure you didn't, no one wanted to sit down and write 1,200 pages if you didn't feel
Yeah.
super confident that you're building something that people would definitely want and need, especially when you're talking climate related.
Yeah. I mean, for us, the first step was getting the right investors.
Hmm.
I mean, I think the idea was one that was a known problem.
Mm-hmm.
You've seen other companies try and do it. Kind of ironically, a lot of the solar originators started out offering investors access to the space. If you look at Mosaic and Wonder, they both enabled kind of a peer-to-peer marketplace,
Hmm.
and they saw good traction with that. But you can't really scale peer-to-peer. It's almost a guaranteed inhibitor to your growth, at
Could
least
you clarify peer
to
to peer
date.
a little bit more?
Peer-to-peer. So I go out, I build a solar system, and there's $1 million of debt for that
Mm-hmm.
system. I then have to go match it with investors. And so I would go to you and maybe 50 other people and say, hey, can you each invest $20,000? Um, in theory, that gives kind of this nice access to the asset class. But what ends up happening is you're constantly dealing with a mismatch of investor appetite and deal flow. And you have binary outcomes, right? So you and I could both invest in one of those deals, look and feel very similar at the onset. I could lose all my money. You could make your 7-8% return, and it's kind of just luck of the draw, which really is inappropriate for unaccredited investors, and even most high net worth investors don't want to have that single asset type of exposure. And so we saw the problem of access, and what we went out and tried to do was figure out how to kind of safely enable people to access. But it was not a glitzy proposition. Anytime you're talking to investors and telling them you're going to definitely have to deal with the SEC, that's tough. And so that's where we started, and we felt if we had a good initial pool of investors, that would help us a lot, and it did. I think not having the investor base that we had would have resulted in us not succeeding or getting to a point of getting the product live.
So it's almost like your team were or are your current investors that were willing to go through the slog and probably like the bare minimum financial requirements you need to hit to even get the door open with the SEC and these bank players and such, because it was access to capital that you guys were trying to open up. You were saying, hey, here's this new market, and exposing individual investors or any investors to a single loan in this case doesn't make sense. So bundling it up, I guess kind of like how bonds work.
Right.
And it's just a series of bundled up loans, and then it's traded and you can buy into that full bond, and then the performance is spread across all the different, I guess, assets that you have nested
That's
under
right.
that is what
Yeah.
the idea was. It was just who was going to be the person to put together the team, which in this case was investors and people with previous experience, which I imagine you learned being one of the early players at
Yeah.
Dividend.
Yeah, I mean, and we have an internal team, so it's not just investors, but I mean, if you look at um, some of our investors, Powerhouse being one that just put out a piece on why they invested, they have a lot of connectivity to the space, right?
Mhm.
So immediately, we've been able to kind of call on them and say, hey, do you have connectivity to this originator? Do you have connectivity to this asset provider, if you will? So that's someone building a solar system, lending into a solar system, or just providing a service to a group of kind of installers doing that. So we've leveraged our installer base or our investor base a lot, and that's enabled us to bring in. I mean, if you look at our team, we have the former chief investment officer of Anthem Insurance on our team. That's a guy that managed over $30 billion of fixed income, primarily fixed income. Insurance portfolios are usually, 80-90% fixed income. So that's just not the type of hire you usually have on a early stage pre-product company, but it was a direct result of our investor base, and he has been a driving force in getting us to where we are. Just given all of his experience, not only investing but starting funds and his fairly extensive background. So that's when we talk about our investor base and kind of early employees. It was a super important factor in us getting this thing live.
Okay, so you're building towards this fund, which is now live. Investors, unaccredited investors can now invest into, I guess, a spread or a fund that's kind of like a bond where there's multiple different solar loans that are nested under it, and you get the aggregate of the returns those loans provide. And by consequence of participating in this fund, you're effectively helping get more solar out there into the market, which directly drives down greenhouse gases, climate, all that kind of fun
Yeah.
jazz. So you got your investors, you now have your early team. There's a 1,200-page document in that process, and the very short and easy SEC process. and a bunch of other things like finding bank custodians and such that you mentioned. Let's talk through that process. How do you as a
Yeah,
founder go, great, I got the hard part done, or at least in your head, you got the hard part done. You just convinced a rock star set of team members and investors to come join in on building this fund.
right.
What's next? How, what? What was that experience like?
Yeah, well, and the other thing I should add is I'm a non-technical founder, right? I mean, my
Oh, that adds to
expertise
it.
is more, yeah, is more financial and kind of project finance background. So what we found was there was actually a lot of technology to build.
Really?
Um, yeah, believe it or not, you cannot buy a mutual fund from the fund very easily. It's a direct-to-consumer product that doesn't exist. It's a
Really?
totally different element of fintech than I think anyone really talks about because it's such a nuance. But we just wanted to offer our fund directly, right? We wanted to do it on the computer or through an app, and that is a novel idea in the world that we
Really?
operate.
So
Yeah,
what's the
so
traditional process like if I can't
all
log
through
into Schwab and just be like, hey, I want to buy into this mutual fund?
that's where it's all through Schwab, Fidelity. They're called the platforms, and
Mm-hmm.
so you're just kind of expected to go on the platforms. But the big problem with that is if you invest through Schwab, I have no idea you're an investor. I just see Schwab as the investor. And so, in our view, we felt that launching future funds, we wanted to know our investors. We wanted to communicate with their impact, how the fund was doing, and have that kind of one to one relationship. That created its own uh, set of challenges beyond just the SEC and regulation and having all the partners in place to be buttoned up on that. We had how do we actually give investors access beyond going through Schwab Fidelity?
And what's the importance of knowing the investor as opposed to, because I imagine most, if you take the Silicon Valley textbook for building the next big thing or building the next Uber, they would have just been like, hey, go to Schwab and piggyback off of them, and who cares? You'll eventually be able to know them. What made that so important in this fund that you were trying to build up?
Yeah, it's interesting because I think that Schwab and Fidelity's are a platform. We will use them as a platform. We're not kind of saying we'll
Sure.
never use them.
Sure.
But when you think about our product and communicating impact with you, right? And what's the impact of your dollar? That's something you can't do with a Schwab or Fidelity investor. And we felt it was a pretty core component to what we're offering. I think over time it becomes um, more or less, depending on how you want to look at it. But you can imagine if we want to do a second fund, and I can kind of ping you through the app and say, hey, is this a fund you'd be interested in? Or rank assets you're interested in investing in. We can build a lot of momentum ahead of time by just being able to kind of softly communicate with those investors. And that's something
I
that
mean,
um, funds are challenged with today because they can't really build a brand. It's just kind of hoping that they get ranked in Morningstar as a good fund manager and good product.
it's almost, I wouldn't even say brand, it's more community,
That's right.
because you're not attracting, I don't imagine you're attracting investors that are necessarily looking for just the biggest gains possible, but they're looking for the best gains or the ideal assets to invest in climate. So it's very climate centric investing that's driving people to Finite and the Solar X fund in this case. Hence, it's a key necessity to be able to tell people here's the impact your dollars had directly. Is that a fair
It's a
playback of what you just said?
fair playback with some assumptions built in that are similar
Okay.
to assumptions we had. The one
Okay.
clarification is we're actually seeing more interest from non-climate people, your traditional finance people, in the space. And that's a whole different rabbit hole to go down. But climate people actually are not, they can be very supportive, but we have found a lot of times they're very vocal. And they actually, when you talk to them about investing in a fund that deploys project capital, they're kind of like, well, maybe. Whereas traditional finance people say, well, this is great. I can get we project our target returns are 6 to 8%. That's 2 to 3 times what you can get in the market right now. And so finance people are kind of like, that's pretty good. I'd rather be in this product. They like that there's low volatility, should be low volatility, and they like that we can access more. So we've been a little surprised. I expected our first 100 investors to be full climate people that did not care about return. Um, they are quite the opposite, and it's a benefit of our product. We can our investor base. I was saying the benefit of our product is we actually appeal to both yield-based investors
Oh,
and climate
yes.
people. The benefit of our product is we can appeal to both your very traditional yield-focused investor, and we can also appeal to your family individual who's trying to decarbonize their portfolio. And both sides can have motivations on impact and things we need to be tracking and yield hurdles. But what we found is one of the benefits of solar is you can really check both boxes with a lot of investors, and that's something that we've benefited from because we're seeing a lot of interest on the return-driven side over the kind of climate impact side.
So in that long, arduous process of building this platform, it seems like what you identified is the finance people actually find this really exciting. And while there are climate finance people, a la you, as a perfect prime example, it almost feels as if you guys were able to early test the fund's concept as you were going through the hoops and hurdles that are there to put in regulation, which naturally is a great way to protect people that are making these investments. So it's a necessity, and I imagine a good necessity that's going to give confidence to people that you survived this
Yeah.
long to get through those checks and balances. But I'm really fascinated. Obviously, your background's in finance, and you've also done climate finance at Dividend. So what led you or enabled you to go ahead, based on your past history, to identify that trend that, hey, investors, just general investors who aren't necessarily looking for climate investments, are going to find this as a really interesting opportunity for themselves?
Yeah, I mean, we've
A bit of a
seen
loaded question.
even in the last. Yeah. Well, I mean, look, part of it is
Sure.
luck with timing, right? I could not have predicted. I don't think anyone could have predicted the massive flow
Mm-hmm.
into ESG, and then I think the subsequent eye-opening of what is that ESG product? I mean, if you look at Q2, you get about 1,000 new ESG ETFs kind of
A
launched, we'll
thousand.
call it. Of the 1,000, of those 850 are just relabeled. So that's a fund that used to be, coal investor ETF is now ESG sustainable energy ETF brought to you by BlackRock, right? And so I think that trend towards more marketing of ESG, it's been helpful in that investors say, yeah, we should consider that. I mean, governance is a good thing just in general. Environmental, social are important. It's hard to have all three, but it's kind of gotten people to start thinking about it. And I think in that you've started to see an investor base say, well, yeah, but we want actual E, S, or G. And if we can get 2 out of 3, that's great. If we can get 3 out of 3, that's credible. But um, it's really hard to have all three in one package in a traded product. Just kind of if you think about the difference in asset classes. So we benefited from that whole trend, and we are benefiting from that. On kind of we'll call that
Okay.
a
So
tailwind.
timing is obviously something that's exceptionally important for any company success. And the fact that you guys have survived this long, again, I'll say it now, I'll say it probably 10 times in the future, and probably in the post that I put out when this podcast drops. Timing is a huge component, but it's also that angle that excites me a lot about this, is that you were not only able to test the need in the market that would be interested in this product, because we got to this point by saying, okay, well, what was the importance of just talking and enabling each individual investors to directly invest in Finite Solar X Fund, as opposed to just piggybacking off just Schwab entirely. Not a little bit of dependence, but 100% of dependence on those kind of platforms. And we arrived at this distinction and understanding that, hey, there's investors that find this product exceptionally interesting. And climate people, they find it interesting, but usually you're starting from a finance background and saying, you know what, I like this fund, and hey, it's also climate oriented, and this is a great alternative to ESG funds that you may not be, or you may be a bit skeptical on in terms of its impact. Because if you're looking at an ESG fund, you're probably also thinking about impact, not just returns. And that's
Right.
what's enabled or drove that technical decision to get that side of the platform built, which I imagine is in and of itself another big hurdle that you guys had to cross. So if you had to like summarize or share with the audience that's tuning in right now, again, if you when you tell me 1,200-page document, SEC approval, and then you also had to kind of build your own platform to enable people to directly invest in you, I get overwhelmed. I also haven't been in the space as an actual builder in the fintech world. So to me, that just looks like rocket science. How did you end up navigating and managing all of those things with your team behind you? Because being non-technical, but having a deep understanding of finance, which I'd argue is the proprietary thing. It seems like you guys also have something exceptionally unique on the tech side as well. But the thing that was going to make or break your company and the Finite Solar X Fund is your distinct understanding of the climate space, the timing of the market, and your background in finance really drove you to get to a point where you can even have a fund, which in your case is almost like a Series A traditional software company finally getting into the growth stage. So, what would you say, in your experience, has been the way to navigate those hills and valleys, or mountains and valleys in this case?
Yeah, so that I'm going to add one more element
Sure.
and then I'll answer that question directly. We also, our fund is buying really small assets,
Oh,
right? So a solar loan is a $30,000 asset, right? So when you think about having a big fund with a bunch of, that's something most funds either can't do or just say we'll do pen and paper and kind of hope. We had to be able to digest all those assets as we bought them. So there's kind of a unique
digest?
portfolio management element to it. As the loan specific information is called a data
Oh,
tape. You have to digest that data tape as a manager and actually know, we've got 1,000 loans in the portfolio. Did we get paid on loan 102 this month or not? If not, why? Right? Is it because the system isn't producing energy? Is it because there could have been a natural disaster in that zip code, right? So being able to zoom in on our assets on a one by one basis is tough. So that all said, when we were kind of building these blocks of our initial fund, the biggest thing for us was just to keep going. There were times where I think we as a team felt like we were running into a brick wall.
what was a
Um,
good example of
we
that?
had okay, one example of that is our initial fund service provider. So the provider that was going to be the
Hmm.
custodian for the assets. Talked to them for 9 months. Oh yeah, this is really cool. We want to be involved in this. But we were about 2.5 months from going live, and they called us up and said, "Hey, our risk team doesn't think we can keep track of these assets. They're too small." And you're sitting there, you're like, "Whoa, this is unlike what I think some, if I heard this, I'd say, well, yeah, you probably just missold what you guys were doing. Like that, you get your startup, you got crystal clear. We had sent them, exactly what we were doing. We had gone through all their diligence. Everything was good. But it turned out they had expected us to be a 20 to $50 million fund. And then I think as we progressed and as more people kind of saw the opportunity, they started seeing it as more of a, we'll call it $100 million plus fund over time. We think of it as more of a $1 billion plus fund over time, but they recognized at 100 million, their systems would start breaking. That's a pretty big, punch to the nose when you're thinking, hey, we're going live in 2.5 months. This element of our business is handled. And it's not only handled, we've been working on this for 9 months handled. That's a pretty, yeah. And there are multiple examples of those types of instances where you just say, yeah, like, come on. And so we were fortunate, and this is where I think team and investors come in. I mean, U.S. Bank, and this sounds like a negative, and it's really not. They're not picking up the phone call from me, right? They're kind of like, no, we've got plenty of clients. We don't need to put in that kind of brain work to figure out your strategy and launch your fund. They are picking up the phone from someone like David, right? Who can call and say, hey, and that's where our team and investor base really kicked in as we hit some of those hurdles that I think a lot of companies candidly would have just said, this is too much of a headache. Let's go do something else. So that was maybe a very rudimentary response to your question, but
it seems like there was vision behind it because they saw this undisclosed company. They saw this as potentially growing to 100 mil, but you mentioned you kind of see this as a potential $1 billion fund. I mean, I'd say, like, screw it, why not? Let's say $1 trillion. But again, it's your vision, your company, right? So what is that vision like?
We think of ourselves over time as a $1 trillion asset manager.
There you go. I like that.
Yeah, but when you look at the space, and if you think just in solar, right, it's about a $15 billion a year market. So that's big enough for us to build a fund around. It's not so big that you can build a $1 trillion fund, right? No, there is no real $1 trillion fund. But when we look at the overall space, sustainability, the flow of capital that's needed in the space over the kind of our generation, without knowing exactly how old you are, I will call it our generation. That's a $100 trillion problem. And so when we think about the opportunity to help there, it's very feasible that someone will be the $1 trillion asset manager purely focused on sustainability.
And that includes carbon capture, hydrogen, kind of like how it's
right.
Are you guys targeting, so Generate Capital, for those of you who don't know Generate, which you should know Generate if you're watching this podcast, Generate's doing late stage financing, hydrogen, DERs, electrification. It's, again, sustainability oriented. Are you guys basically the early innings of Generate?
So Generate's a great company. They have a phenomenal team. Obviously, Jigger's founder there. He's, great product team. They're actually doing more brain work than we want to be doing. They'll go into asset classes really when there's still a lot of technology risk, and they'll bring in highly specialized people to figure out if they can really how to price that risk. And they'll do small deals, they'll do large deals, but they'll take a lot of technology risk and subsequently get a lot of return for it. The two differences, we think of ourselves as the phase after Generate. So when you're developing projects, Generate's a great first stop because they will do the brain work for a $5 million deal. We can't do a fund that's especially a $5 million fund
unaccredited investors.
And doesn't. and has a lot of risk. Even if there's upside, oh, we could make 25% a year. It's not the product
Right.
we want to be offering. Um, and generate, I think when you kind of play that out one step further, they've gone to initially they went to kind of family offices, high net worths. They've now brought in some really high institutional quality, but they're your high impact, high reward, slightly higher risk, although as they've grown, they've had to, I think, grow that asset base a little bit as well to be less risky. So we're that next step. Our capital should be cheaper, it should be more efficient, and as such, we should be taking a lot less risk.
I find that fascinating because then it's, let's say, hydrogen suddenly becomes a asset class that's mature. I'm going to use the word mature as you did in the beginning around solar. Um, it's almost like now once it's reached that stage, you may have finite hydrogen X, or you may have if VPPAs become
Yeah,
superbly valuable and they can be bundled, then you might have finite VPPAX. Or again, I'd imagine the naming convention's a little bit more intelligent than that in the future, but
yeah,
I guess that's the general principle of the vision of how you map or help everyday people like myself just participate in funding and financing when we're not the billionaires that can make that kind of capital decision, but we can invest 500, we can invest 5, 10, 20, $30,000 of our own money in order to help
yeah,
bring or drive more projects or infrastructure to be developed. That seems to be the key to your vision to getting to that rocket ship target of $1 trillion in assets managed by
yeah,
Finite, the entity. Is that a good
yeah. That's
playback
right.
of what you're building towards?
Yeah, I think that's pretty good.
Well, I guess then the the way I'll put it is it seems like that's that's a recurring theme is if the vision and the target is that big, and you see this with companies like even like Pachama and Diego and his initial founding team,
Yeah,
the ambition is really the driving force that pushes you through the insane complexities that come with building a climate related company. I can speak to that as well. But I think then I'm going to leave the audience with that to chew on. And I imagine we'll have plenty to talk about in a year after seeing the activity within the fund. So we'd love to have you back on in the future, Kevin. But I want to give you an opportunity
yeah.
to just share anything that you think the audience might want to know before you go back to getting to that or getting closer to that $1 trillion asset fund.
Well, look, I mean, we've kind of said it, but I'll highlight this is open to almost everyone, right? $500 a minimum. It takes 90 seconds to become a solar investor, and everyone should go do it. It's intentionally simple process, and we are looking forward to kind of growing that audience and that community that you
Awesome.
spoke about.
Well, I hope a few people decide to go at least check you guys out. We'll have the link in the description in the YouTube comments as well. So I really appreciate you coming on, Kevin. I'm going to let you jump now. And I can't wait to see what people say once they hear more about this.
Awesome. Well, thank you for having me.